Hey guys, welcome back to this week's UTrade Rundown. I'm Lance, and today we're checking in on one of the PSEI's best performing stocks, International Container Terminal Services, or ICT. With the conflict in the Middle East, higher fuel prices, and almost no activity in its Iraqi terminal, you'd expect ICT to have a tough quarter, but it was actually able to stay resilient. In the first half of the year, revenues jumped 27% year-on-year, while net income grew 23%. Container volumes also rose 16%, and ICT also earned more per container with a 9.5% increase in average yield year-on-year. So, where did that growth come from? Most of it came from new terminals, particularly Durban Gateway in South Africa and Batu Ampar in Indonesia. But if we exclude those, organic volume growth was only about 1%, suggesting that this year's growth was driven more by expansion rather than stronger global trade. Even so, trade has held up much better than we expected. Earlier this year, we thought higher oil prices would weigh on shipping demand immensely, but volumes for the most part stayed resilient, prompting us to raise our full-year throughput forecast from a 5.4% decline to a 14.8% growth. Now, it's not all good news. On a quarter-on-quarter basis, container volumes actually slipped 1.3%, mainly due to weaker trade in APAC, and as ICT continues its expansions amid higher fuel prices, it will definitely see increased operating costs as capacity expands. In fact, we saw this when EBITDA margins went down from 67% in the fourth quarter of 2025 to 64% in the second quarter this year due to a 38% increase in OPEX year-on-year. Management expects margins to recover once Iraq resumes normal operations, but we think that it could take longer as higher fuel costs and ongoing capacity expansions continue to pressure expenses. That's it for this week's rundown. You can actually read a more in-depth analysis and easily digest our insights on ICT and other companies when you open a UTrade account today.